Hello, jury. Hello, everyone. We represent ITAM, and our team is formed by Luis, Adriana, Pedro, Bernardo, and myself, Mauricio. And today, we're going to explain to you our sole recommendation on Grupo La Comer. Before we begin, let me guide you briefly throughout our presentation. First, we're going to talk about the key downsides of the firm, then the ESG analysis, later the financials, and finally, the valuation. Our sole recommendation is based on 3 key points. First, La Comer's premium growth model has no room for expansion. Second, La Comer ESG profile adds up risk. And third, even though that they have great gross margins, that doesn't translate into profitability. These 3 factors combined affect the value creation of the firm. Now, Luis is going to explain to you the key downsides of Grupo La Comer that align with our view.
Thank you. After a risk analysis, we have detected 3 key downsides: sensibility to economic slowdowns, intensive competition with hybrid players, and the impact on the minimum wage and the labor reform. First, going to sensibility to economic slowdowns, we can see a clear contrast between La Comer's premium growth before the pandemic of 13.5% and 2025 of only 9.5%. There are two drivers of this slowdown. The Mexico's GDP slowdown momentum and the narrowing in the premiums. We think that La Comer's growth story has reached its limit. Here we have intensifying competition from hybrid players. In this diagram, you can see Mexico's grocery retail market. As you can see, premium formats of competitors such as Walmart Express and Chedraui Selecto have good enough shopping experience with better prices. The once isolated market location of La Comer is now clearly under threat. Finally, talking about the minimum wage, Mexico has seen an increase of over 120% since 2020, with an already announced 30% from 2026. We question La Comer's ability to absorb these wage hikes and a possible reduction in the work week without pressure in the margins. These downsides highlight many structural vulnerabilities that can be further seen if we examine ESG, as Adriana is going to do next.
For our ESG analysis, we decided to benchmark La Comer against the SAS Food Retail and Distribution Standards, the IFRS S1 and S2, and disclosures from competitors. Starting with environmental, La Comer reports partial energy usage and only Scope 2 emissions. However, it does not disclose any climate targets, any climate risk analysis, or any waste metrics, leaving it behind IFRS standards. On the social aspect, La Comer lacks transparency. Although it performs well on a customer experience with a strong NPS score of 73.5 and multiple product quality certifications, it does not report any supplier audits, any labor or safety metrics, which makes it hard to analyze for any operational or supply chain risks. Finally, its governance board raises some concerns. As the diagram can show, its board composition resembles more a family-owned company with 6 out of 10 members belonging to the Gonzalez family, which raises concerns about oversight, independence, and accountability. Overall, La Comer fails to disclose most ESG requirements across all 3 dimensions. But now we're going to move on to the financial analysis, which will be explained by Bernardo.
La Comer has delivered the highest revenue beyond peers. If you see, this has been delivered because of the premium pricing and higher average ticket. Things has done very good, La Comer. But the problem is, this premium strategy is now reaching a ceiling. The high income in Mexico is very small and already crowded. Most of the A and B plus zones have already been taken by La Comer. And going beyond that will dilute La Comer's brand and even expose them to price competition. A price competition La Comer simply cannot match. So yes, the premium format explains outperformance, but also explains why this outperformance won't happen in the near future. Moving on to the margins, La Comer has the highest gross margin, as you can see in the graph, but the problem is they can't translate this advantage into real profitability. If you watch, the EBITDA margins are very similar between competitors. The problem and explanation for this is in my next chart. The SG&A. La Comer has the highest SG&A in all the industry. The problem is that the premium formats require a lot of labor costs that totally vanish the profitability of La Comer and the advantage of the gross margin. Moving finally to the balance sheet, La Comer has the most solid balance sheet in the industry. If you see the graph, they have been operating in a net cash position for years, which leads them to being virtually with no leverage, which is great because provide them stability and flexibility to fund growth by themselves, although that makes the WACC to be higher than peers. But the problem is that this capital structure doesn't really translate into real returns. If we see the next chart, La Comer's ROE has been consistently below peers. The thing is, premium formats require very heavy investment, the scale is very slowly, and as we saw, doesn't even give very good margins. So that limits the capability to make real returns. Now, we'll move to the valuation analysis with my partner, Pedro.
So we model La Comer strictly bottom-up. Instead of doing a single growth assumption, we identified that revenues come from two main sources: expansion in selling space and growth in sales per square meter. Our first graph displays our forecast for selling square meters growth, while the second one links that expansion capacity to revenue creation, combining new space addition with a steady same-store productivity growth. In short, our revenue outlook is mechanically derived from unit economics and not from arbitrary percentages. And also, our moderation in added square meters reflects a premium format nearing saturation. Now, our valuation is fully aligned with the principles we have discussed so far. One of the key drivers for this valuation was wages growth, which is the largest SG&A item, because it outpaces productivity, systematically limiting free cash flows, and also prevents margins to expand. Therefore, using a 12.97% WACC, a 4.05% terminal growth, and a 30% long-run gross margin, our DCF yields a target price of 34.85 Mexican pesos, implying a 15.9% downside. The sensitivity table also shows that across reasonable WACC and terminal growth combinations, the intrinsic value falls below the current price 72% of the time. We also tested this model under two long-run scenarios. For the bear case, sustained labor pressure, weak ESG performance, and a premium format near saturation drive a 29.9% downside. Now, for the bull case, we allowed for some labor pressure relief, for some improvements in ESG performance, and also a more diversified format strategy. Yet, the upside is only 1.7%. So as you can see, across both paths, the message is really clear. La Comer's reliance on a costly, premium-heavy format leaves very little room for future value creation. To deepen our evaluation, we also ran a Monte Carlo simulation using multivariable T-student shocks in the key drivers, which were revenue growth, capex to revenue, gross margin, and salary inflation. So as you can see, the current price falls in the right tail, and the target price is very near the mean. This is an indicator that there is a very high probability of downside once these key drivers are stressed.
So finally, why did we decide to sell La Comer? That was because of the three key points that we presented in this presentation. First, because La Comer's premium growth model has no room for expansion. La Comer is not growing and is not going to grow in the near future. Second, because La Comer ESG profile, it adds up risk. And third, because even though that they get premium gross margins, they lose a lot of value and a lot of money through operating expenses. And that's why we decided to recommend selling. Thank you.
Thank you. I was wondering if you can expand on how did you get the ESG profile to impact your DCF valuation?
Okay, basically, we have an annex, if I can show you, we have many annex. So, here, we did something like this. We did an augmented FAMA French. We wanted to see if the FAMA French model was fitting Lacomer's profile. We saw that actually with the regression that the relevance statistics was the one that we added, that was illiquidity and ESG. For ESG, we use S&P score for all of the EPC components. Lacomer was falling in the lowest part, and we use a Amihut illiquidity ratio to capture illiquidity. We know that it's a public traded stock, so it's not necessarily illiquid, but it's illiquid compared to peers. So basically, we run these portfolios. High ESG score and low ESG score in the Mexican market is the top 10 and the lowest 10. As you can see, there's a breakdown between 2022 when there was a reallocation of prices. So we take into account that to see that the market probably is not adding an ESG premium to Lacomer, but is seeing that there's not enough disclosure, there's not enough governability and sustainability in the model, and they're falling in the lowest part of what the market wants right now. The same happened with the liquidity. Lacomer is in the liquidity part, and there's a complete difference between both portfolios that were used in the regression.
So it's increasing your WACC, or how is it entered?
It is increasing our WACC. We put it here. So basically the betas and the ESG factor, we added a little bit. We try to be consistent with academic research, but there is not enough academic research in ESG premium because it's not conclusive, and also with illiquidity. But as we said, it's not like ESG factor and illiquid factor. It's not like capturing some trends that the market is telling about governability, sustainability, and that's what we use those premiums. The normal CAPM ones were the ones from Damodaran, and we use the MA bond of 10 years. So that's how we constructed the equity, and because Lacomer is basically mostly equity funded, it's really close to our WACC. So that's all of the weight in our WACC analysis.
So if I may, another one on valuation, how did you pick your terminal value multiple? Because it's a very sensitive number.
Yes, we have an appendix, I think so. Let me search it. I think it will be, okay. Well, we use the key value driver formula. Here it is. Okay, like you see, we did the formula that we did some assumptions in between the reinvestment rate and the RONIC. As we our first thesis is that Lacomer won't have much more space for expansion, no? So the reinvestment rate they were using was like 56%, something like that. So we try to reduce that. It's the same with the RONIC. We assumed it with our analysis and lead us to a terminal growth rate of 4.05%, which I think aligns a lot with the inflation expected in Mexico and the GDP growth for Mexico. So yeah, basically it was that.
You had multiple.
Multiple valuation?
The terminal multiple?
Yes.
Yeah. This or for the terminal growth? I didn't understand the question.
No, that's okay.
I believe that for the terminal multiple, where it's about the perpetual of future cash flows in the last year.
Well, I don't know if you're asking if we used a multiple for the terminal value.
It appears to have a multiple.
In the valuation, we can.
Exit multiple 6.9.
Yeah, so that's basically the future cash flow for 2035 divided by the WACC minus the growth rate, which Bernardo has already explained. And yeah, that's it.
Okay, one question. A big part of your sale thesis is based on the assumption that the premium strategy is almost dead. But where do you see evidence on that? Because I see growth continues to deliver. Same-store sales are growing above any competitor. Margins are still expanding. So I don't see still any evidence. And since the first year, you're pointing towards a deceleration.
Actually, we do have same-store growth here in an appendix, and it's not quietly evident that La Comer is delivering better than the peers. It's close to Walmex, and it's below Chedraui. We have Soriana, that it's a different case, but we don't see that here. And we also have...
Right?
Yeah, the average of the last 5 years, if I'm not mistaken. And we have like the revenue growth of La Comer and peers, and it's converging to the industry mean. So we think that, yeah, the story for that component is almost, no, this is not, this one. As you can see, Chedraui has explosive because they are using a different strategy for expansion, but La Comer is over the peers, but not exactly with a great premium. As you can see, it's almost converging to the mean with Walmex and Chedraui.
You mentioned different variables for your call. I mean, for your sales decisions, there were internal economic variables, and there were also some structural variables in the company. If you have to choose just one thing that you can change in your thesis, and in this point you can have a better opinion of the company, what do you think that is the most important factor that the company should be working at this moment for change your opinion?
Like, can you repeat the question? Like, you're asking what will we change for our assumptions?
No. I mean, once that you said that you're not feel comfortable with so many factors, if you have to choose one factor that can make your opinion, what do you think that is the most important risk or the most important factor to this company?
Yeah, the labor, basically. Like, as we saw, we also have an appendix, but I can go back to the presentation. Like Bernardo explained, where it is, here. Like, we were saying that La Comer, even though that they have like great gross margins, they lose a lot of value through operating expenses. So that's like literally the most important risk that the company is facing. Also, given that the minimum wage is going to increase and they haven't do anything in order to change like their labor, that is like the thing that we say is most important.
Yeah, basically, we have an appendix, and I can explain to you when we are going there. But basically, La Comer hasn't been increasing their average wage like the minimum wage. And before, like 10 years ago, probably in the industry, the minimum wage wasn't a binding constraint compared to right now, because right now, the entry-level jobs in La Comer and other retailers are going closer to the minimum wage. So an increase is going to be more relevant in further years if this trend keeps going up. So, well, no, this is our assumption for the model. Sorry. No. Basically, we have the labor cost here, sorry. We have the labor cost increasing with the minimum wage, but this is the minimum wage increased cumulative in the last 5 years against La Comer average wage increased. But if we are thinking about entry-level jobs, they are gonna really be driven by the minimum wage.
And I also want to add that among peers, La Comer is the one that has the most employees per square meter. So we will stick to labor.
Thank you so much for your attention.